I lost all my screens, and the only way that I could get them back was to reboot my computer. I think maybe there's something going on with my graphics card or something, but I wasn't even really pushing my computer at that point, and I lost all my screens. So if I lose my screens during this, I'm going to need to do a reboot, and I will not restart the morning briefing if that happens. So it won't. I'm mentioning it so you don't think it's on your end, and you don't try to mess with your settings. Good thing is it's all visual. So if I lose my screens, you'll at least be able to hear me say, that's it, I'm gonna have to reboot. And since it just happened, I don't exactly know what I'm gonna do about it. It's a fairly new computer, like a year old maybe. And it's an expensive computer. I think it would last longer than a year and a half, no matter how hard I'm pushing it. But I just wanted to put that warning out there in case it happened. It's always something. All right. It's OpEx. This is options expiration day. As we can see, it's the third Friday of the month, and that is OpEx. So it's something that you can plan ahead for. Even if you don't quite understand all of the different nuanced pieces of options expiration, you can at least appreciate the fact that there's going to be more volume than normal. And that volume can be misleading. If they're rolling their positions, then you're going to see a lot of activity, but it's not new activity, right? It's not a new bias. They're not coming in aggressively trading to the upside or the downside per se. They're just rolling their positions around. Hong Kong is down nearly 1.5. Japan down more than a quarter. The NASDAQ is flat, S&P up a quarter, Dow also. And then all by itself, we have the Russell up more than 1%. A dash for trash, penny stock extravaganza, left for dead, rallying up off the bottom, any way you want to look at it, right? Kind of go back and look at the NYSE and all of its names, and the Russell 2000. Basically, you could just do a search for things that are underneath their 200 period moving average and or things that have recently crossed through their 200 moving average, and you'll start to see the names that we're focusing on here a little bit. It doesn't mean that they're all bad, right? There's just a lot of names that we're going to see moving that are getting perhaps a little bit of a short covering rally, and it's not much of like a capital rotation per se, unless those are defensive names. We've seen utilities kind of coming up off the bottom. Maybe we'll see more, industrials, healthcare, that sort of thing. And it does seem defensive in nature when I say it that way. But it's more just a focus on the rotation at the moment. Think January, February this year. Now, 2 months ago, we were talking often about performance chasing as we get closer to the end of the year. And when we started to sell off deeper, I had mentioned that it wasn't going to be such a big deal, right? When we were sitting down, say, at 4,100, it wasn't as big of a deal because we were so much closer to where we had started the year. That performance chasing argument didn't really come into play anymore, but it does now. So it's something that we're going to be hearing more about as we get closer to the end of the year. fund managers are really going to have to try to explain to their clients why you should give them your money to manage and why they couldn't do something as simple as beat the S&P 500 in its returns. So they're going to want to come in and get their returns, right? It's kind of the idea behind performance chasing. So you're going to want to look around for that to find where the flows are going. We were talking yesterday after the close about Market Chameleon and the MOC orders, how they were nearly equal, and they hadn't been for 2.5 weeks. How many weeks was this? Oh, hey, 2.5 weeks. So after this amazing flip and run up, the MOCs have been heavily weighted on the buy side, and that gap between the buy side and the sell side had been fairly wide. There was no gap yesterday. There was like 3 names different between those two, the buy side and the sell side. So, you know, it's something that I tend to pay attention to. You don't need an account to see this. You can just go to Market Chameleon, stock order imbalance, and after the close, you'll want to look at these 2 numbers. There's your buy side, there's your sell side. You see how they're nearly identical to yesterday. The day before, there was at least 40 names different. Here, there's 156 names different. You can see that there was a spread there, 50 here, 200 here. So there had been a strong spread. And then yesterday, no spread. We're going to get some housing, and we've got Fed speakers out there chipping teeth. If it's a continuation of the same stuff that we've been seeing, through most of this week, they're just talking out the side of their neck. Nothing new to say, and it's the same old thing, singing from the hymn book, that they think they're there, but they're not quite sure that they're there, and they're holding the right to vote for another increase if they think it's warranted, yada, yada, yada. Basically saying, we're going to pause without saying we're going to pause. Because the words pause have a historical precedent to it, and they know the effects of saying it. And so they just refuse to say it, but they continue to do it, not pausing or not pausing. We don't have a quote high impact event today. Got some medium and some minors. The main thing today is just going to be OpEx, options expiration day. Now, there was some talk yesterday about the market pulling forward a rate cut to mid-2024. This, I believe, is wishful thinking and a little bit of unrealistic expectations, but either way, we're at 5.25, and the highest anticipated place that here is 475 to 500. So that's a significant cut there. That's for July, or July 24th. But we can look at June, and they had one in here too, almost neck to neck, right? So they're looking at, a cut here as well. They're pricing in these rate cuts, and here in May, they're pricing in cuts for May, June, July next year. Multiple cuts going from 525 down to 5 and then 475. That is some serious wishful thinking right there. The Fed continues to beat that drum that says we're not going to cut. We're not going to cut unless we have to. And they're honestly, they're looking for something to break first. They're not going to cut until something breaks. So these are helping buoy this move that we've been seeing, this exuberant rip to the upside. Just kind of keep in mind with this exuberant rip to the upside that it is all just this. It's just pricing this in. And when the market gets butthurt because they don't get their rate cut, or they finally hear a new message where and it's not the new message, it's just the message that the Fed is going to stay high for longer, then they're going to need to unwind these, and that's going to be a move to the downside. So when that happens, right, it could be mid-December when Powell comes out, because we've got an FOMC meeting there. Maybe they'll get the message from him then. But if not, then maybe they'll get the message from him in January. But so far, that's what the market is looking at. And, you know, it's not just the market. It's whether you listen to Goldman Sachs or if you're listening to, you know, Bank of America. Some of these analysts are calling for late December 2024 as the first kind of area for a rate cut. But there is one firm, and I don't want to name the firm because I can't remember which one exactly it was. So if I name the wrong one, then I just put the label on them. But one of those firms was calling for a mid-year 2024 as the first cut. So, you know, if you've got some major institution, some big firm out there saying they think the cut is going to start in June or July, then, you know, can't really blame the market for doing the same thing, for starting to price it in. But there's conservative estimates, and then there's, you know, wildly exuberant estimates. And I think pricing in a rate cut for June and July is unrealistic, and the market's going to unwind that at some point. And when they do, that'll be a move to the downside, but it won't be today, right? And it won't be this week. And that's kind of the idea here, that we're very likely going to get into that 4,600 and 4,650, that we're going to see, you know, new highs on the year. Not all-time highs, maybe, you know, not never before seen highs, maybe, but certainly new highs on the year before the end of the year. That really isn't all that hard to imagine, considering how far we've already moved from 4,100 to 4,500 in just these past 3 weeks. And as much as it is, quote, overbought, or it seems like it's gone too far too fast, I can show you that we haven't gone too far too fast, and that there's still plenty of room to go before we could consider that. Now, it all depends on your time frame duration, right? So on a 15-minute chart, we are greatly extended from our weekly pivot point. And from that point of view, we wouldn't really expect to expand beyond this range that we've already set on the week. We can wick a little bit higher than that, sure, but we don't really have an expectation that we're going to close higher than that. And that's a point of view that kind of lean towards overbought, that we have moved very far this week on Monday, and that we'll just be doing good to keep it. We're a long ways from zero gamma. We're a long ways from the volatility trigger, and the call wall still sits over our head at 45.64 now, but there is still a call wall up there. So even if we did get a breakout rally today and we get through the ADR half at 45.50, there's no chance that we're going to cut through that call wall today, right? I say that, but, you know, statistically speaking, there is a chance. I don't subscribe to that theory today. And I think that it might be a good day for a 0-day play with maybe some at the money calls if we get anywhere near that red line, that ADR half, 45.50. I'm thinking SPX 100 point wide credit spread at the money, collecting something like $42. That's 42 and a half credit, right? So that within, oh, I don't know, 90 minutes or so, you make about $4,000. Close that thing down. I do love my at the money credit spreads. Yeah. So that's on watch today. If we get a nice run up into that red line, look to take that SPX at the money credit spread. You can use the XSP if you're uncomfortable with the size of the SPX. The XSP is also European expiration, which means you don't have to worry about early assignment or anything that. And it's cash settled, so you don't have to worry about that either. You get all the benefits of the SPX without the size, because it's the size of the S&P, the SPY. So it's not as liquid. You know, there's always a trade-off. There's always something. It doesn't have the liquidity as the SPY, but to be fair, nothing has the liquidity that SPY has. No, I'm not suggesting that today won't be bullish. I was actually pointing to a red line that is over our head, right? 45.54 when we're sitting at 45.36. So, you know, I'm talking about a good 20-point move to the upside after the move that we've already had today, because we're already up 0.28. So I'm kind of agreeing with you. I see a bullish Friday too at this point, but I don't see a bullish Friday that's going to run us into the yellow line up here. It could, by all means, it could. But to do that, it's going to have to get through that call wall. And remember where the greatest level of options were located at that 4,400 area that we left behind so long ago. Those puts are going to be rolled out, monetized, scratched, right? Because a lot of these were sold to open. So optionality is just going to be a really big deal today. The calls, the puts, all of it. And the idea that there's bullish Mondays. Well, we've been having a lot of bullish Mondays or bullish Fridays, and we've been having a lot of those. You can always take that into account because it's seasonality and it makes perfect sense. But you also have to take into account OpEx. This isn't just any given Friday. This is options expiration Friday, the third Friday of the month. So when you say something like, we've been seeing bullish Fridays, how many bullish Fridays have we had for OpEx? Go back over the last 11 months, 12 months, and look at every single options expiration Friday, which is the third Friday of the month. How many of those Fridays were bullish? Then you would have a more accurate data pool rather than just looking at all Fridays equally. But I'm still agreeing with you, though. I think that we can get to 45, that red line. 45.54, pretty easy. And maybe even 45.64, which would put us into that call wall. Ten-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. Hey, look, we're at the highs. When we're at the highs, we expect to go to the lows. The point of control is very likely going to be at our location by Monday if we maintain this range. If we break out and continue to the upside, then the point of control will very likely have to lose more of this volume from down here, and then it will just by default move up to 45.20. So it depends on how soon it's going to happen. I think if we work our way through the day, just staying in this zone, we'll bring the point of control up to us because we'll outpace the amount of volume down here. But if we break this high and continue upwards, then we won't build any more volume at this location. And we'll have to wait for this volume to subside. And that will happen as each candle here disappears, right? Because every new candle we get on the right subtracts a candle from the left. we still have to get rid of that 43.25 volume. Then we'll start working on the 43.80 area volume, and that'll deal with our point of control. This isn't quite a classic B shape, but it's a little close to a classic B. It's the start. Very big, shallow area still. So massive air pocket of risk. If we do break that hard 4,500, we can very easily cut through this entire zone and get down to 44.20 easy. There's really not a lot here to help it out. We moved through that zone really fast, which is why it's still really shallow. We didn't leave much of a trace behind. So if we break this low, we're very likely going to make the same kind of move on the way back down. So we had a point of control carried forward from the previous day. We ended up hitting it right before the open yesterday. Although it looks like things shifted, it's very likely that I grabbed it and bumped it at some point yesterday. We still hit it before the open, so technically it was done by then. I left it on for the rest of the day. We really didn't see much of a reaction after that first reaction, which isn't a surprise. It's generally how it goes. And now we've got a point of control underneath us, way down here. So if we do happen to start heading to the downside and threatening that 4,500 that we were discussing, it would have to cut through this point of control first. Now, that won't be hard to do because this isn't a volume. VPOC isn't support, it isn't resistance, it isn't anything like that, right? It's just a key area to be monitored and be aware of. I like first touch plays with these, but you know, it's about a 50-50 chance that it actually rejects at one of those levels. So you don't want to just put your order on the dome and hope for a bounce, because that's about as good as a coin toss. We're seeing a lot of volume at our location, even though we haven't spent as much time there. The TPO is showing us that we spent more time along the bottom than we did along the top, but the point of control on the volume profile is showing us that we've got more volume up here than we did down here. Kind of makes sense, but it's just good to know where the flows are at. And it's Friday, so we start looking at the new weekly expected move. Now, the thing is, this new week isn't here yet. It doesn't get set into stone until 4:15, the end of the day today, but we can already see the levels. Through the day today, if you was to sit and watch this thing, you would see that these levels expand and contract, and that gray line will continue to move because that gray line is where price is. So as price rises and falls, that gray line is going to rise and fall. And these outside lines, the green and the red, are going to contract and expand based on the volatility through the day today. At 4:15 tonight, it will lock into stone. It won't move again, and we'll have our next week's range. One thing that I like to do on Fridays, even early like this, is compare it to the week that we just had. So if I take that box for next week and lay it on the week that we just went through, we can do a really cheeky comparison and just ask, are they pricing in more volatility for next week than they did for this week? If the box is bigger, then yes, there's more volatility. If the box is smaller, then they've reduced volatility. I didn't measure it to the tick. You know, I didn't punch in the values to get it spot on, perfectly accurate, but at a glance, it doesn't seem to be bigger or smaller at this point. So it's a continuation of the same. And that means that they're still undershooting VWAP, that they're still undershooting volatility. We can say that fairly confident because of all these red boxes that I've got marked out back here. And these boxes are marking where we closed at the end of the week outside of the weekly expected move. Standard deviation suggests that we should close inside the box 68.99 blah, blah, blah % of the time. Call it 70%. We should close inside that range 70% of the time at the end of the week by Friday's close. And to be fair, to say it another way, we should also close 70% of the time on a day-to-day basis within that range. But we don't really focus on that one. We just focus on where did we close at the end of the week? In the box or outside of the box? Missing once in a while is common. It's normal. Nothing, is 100% accurate. That's why 70% would suggest 3 out of 10 weeks closing outside the box is okay. If you count back 10 weeks, we've closed outside the box more than 3, more than 50%. And that suggests the next piece, that missing once in a while is okay. It's fine. Do you start missing repeatedly again and again, that the market makers and or that the optionality isn't coming through the way it should, right? So where do these numbers come from? How do we derive this range? It comes from here. Now, to be fair, our Thinkorswim coding cannot actually grab these numbers. So the guy who created that indicator, Mobius, he came up with his own way of getting these numbers without actually coming to this location and getting it. And his isn't perfect, which is why when you hand draw them, they're much more accurate. But they're close enough, right? It's not inaccurate enough that we need to stress about it. It's just not as accurate. But what we're looking for is next Friday's expiration. So right there, $57.65 higher, $57.65 lower. Put it together, that's a 114-point range from its highest to its lowest point. And it's based on how many days we have to expiration. This is an implied volatility average. What's it averaging, right? Kind of need to know that. Where does the average come from? It comes from all of the out of the money options on the put side and all of the out of the money options on the call side. They take all of those out of the money options, implied volatility values, and they average that number. And the number that we get gives us this 10.72% implied volatility, 10.77, 10.62. You kind of get the idea, right? So this range is a mathematical formula derived from expected move and then taken with the square root of time and a little bit of proprietary math that the brokers won't share with us. So we don't know exactly how they get this number. And no broker shares that. So it's not just Thinkorswim. And what we get is this range. Okay. So if the out of the money options aren't reflecting the implied volatility that we need to see, a high vol, then this range won't get bigger. It will be coming up short, like we see here. It's too small of a range, too small of a range, too small of a range. A lot of times we blame the market makers and we say, oh, the market makers didn't put in enough volatility. They didn't price in enough volatility. But it's not always them, right? More options data continues to show that more and more traders and institutions are moving to the front end to do their trading. Well, if you don't bid up these options, then they don't get the traction that they need to change their implied vol vals. And if you don't change the values, then you don't get an accurate box. This is the ES futures, and there is way more liquidity in the SPY than in the options than there is in the ES options. So you would have a much more accurate box if you were to apply it here. You can see the open interest, 22,000, 13,000, 8,000. Way more trades here, right? Not yet in the volume for today because, options aren't open yet. But way more activity. So these will be much more accurate in its expected move. if you're focusing on expected move. I show the ES in the mornings because it's just an easier product to evaluate, right? It's got a nice, clean overnight chart, but you would be better served using the SPY or the SPX if you're going to look at expected move values, because it has a much more liquid options trading, and these values are derived from the options chain. Makes sense, right? Use the one with the better data. So I mentioned earlier about being overbought, but not too overbought. On the weekly, we've got plenty of room to go to the upside. Right now, we're looking at the 10-day. We're 1.83% above the 10-day, and that's a bit high, but we were higher, right? We were at almost 3% above the 10-day, and now we're working our way back down. So sure, we're above the 10-day, but it's not that bad. But we were looking at the weekly when I said that we weren't too overbought. We're 3.4% above the 10-week, and we've been higher than that even just this year. We don't even have to go back very far to see when we were much higher than 4% back here in June and July, or back here at the start of the year in February. You know, we've been at these higher levels. So we are extended. Sure, I'm not discounting that, but we're not too extended. It doesn't owe us a reversal. If you think about the bungee cord, right? It's the analogy that I like to use, that when the bungee cord is stretched to its absolute fullest limit, and there's just no stretch left, and it starts to revert in the other direction, there's no stopping it, right? It's just this massive reversion to the mean. Well, we're not at that point. We haven't stretched to the edge of our limits here. There's still room that we could expand, and it still wouldn't be considered overbought. So it doesn't owe us a pullback. And in fact, it doesn't even need to pull back. It just has to stop advancing. If it stops advancing, the 10 will do all the work, and it'll move up to price all on its own. So it doesn't need to turn around and fall back to the 10. It can just hold the line. We're a little overbought, but we're not extremely overbought. So the whole idea of shorting this market just because of how far we've gone, it's a really bad idea. And I know Tasty Trades made it popular. They've got that aggressive contrarian trade strategy, but not to be applied to indexes. You can use that in the equities to your heart's content, but the indexes are their own beast, and it's ill-advised. So NVIDIA is still inside this big, massive candle. It's still stuck within its own trash, but we do have surge. We have price above the 4 and the 10, or the 3 and the 10, and we've got the 310 cross. That is the surge, 100%. That's all the pieces. Amazon is starting the process for the surge. We've got this beautiful recovery candle here. That's just an absolutely amazing recovery candle. Then we've got the crossover. So we're already through the 3-period moving average. Now we need the 10 cross, then for the 3 to cross the 10. That would still be inside of this big red candle. So from that point of view, you know, it's still considered dangerous or risky, or, you know, whatever language you want to use there. As long as we're still underneath this, then taking a long here is risky. But dollar cost wise, or, you know, the amount of risk you have to take, your risk is less from down here. than it would be if you were buying it on the breakout. Because if you bought it way up here on the breakout, where does your stop go? Way down here? That's an $8 stop. Buy it right now, where does your stop go? Way down here? Well, that's a $3.50 stop. So your risk is less here, dollar for dollar, but it is, quote, riskier because you don't yet have confirmation of a long and you're still underneath that 50% mark. This could just be a halfback, right? So we run up, hit the 50 and then continue to the downside. We don't know, but that's a good start. I really like that recovery candle. I love it. It's fantastic. Same thing with PayPal. We've got these two moving averages about to cross, and we're coming up into that 50%. So this could be a halfback that we just get to the 50, maybe overshoot it a little bit and continue our move to the downside. But if we measured all of this, this just seems like a pullback before continuation. Netflix looks good. No slowing it down yet. The candles are getting smaller and smaller. So it kind of implies that we're going to break and pull back, but we don't have that break or pullback yet. And so I wouldn't try to short it. Even when we do look for Netflix, I think not going up would be a better trade than shorting it. Right? Those are two different biases. I don't have to think that Netflix is going to continue to go higher and put on a trade that says, I bet you don't go higher. That's different than I think you're going to go down. So maybe an at the money or slightly out of the money call credit spread on Netflix, somewhere around that 470 area. That'd be a nice gap and fail, right? Because we do have that gap up this morning. Sucks in a little bit of bullishness and then dumps down like we had on NVIDIA when we gapped up and it made that little run up and then dumped. Kind of got that set up here for Netflix. I don't know about the dump part, but the not going higher part would be what I would focus on. Tesla's giving us the clues of what we could expect from PayPal. We already got the cross. Right now we're inside day, not IX10. And if we're looking for a continuation in Tesla, then we have to, at the very least, get through the open of yesterday, 236.43. And of course, that's not necessarily yesterday's open. I'm on a 12-hour chart, so we'd have to go to a daily to get the exact open, but just the same concept, same logic. And it'll be a little bit of a risk because we do have the 50% mark, the half back of this pullback. You could use that for your target using something like the 240 calls, and or you could just wait for it to get through there. But this really nice run up with a pullback before continuing higher kind of makes sense. It gives us that scoop pattern. Apple had that gap close at the 191 and stalled out, but we are still holding the line. So, this is one of those trades where you could aim for, hey, I don't think you're going to go higher, but I don't necessarily think you want to try to short Apple. Shorting Apple once in a while works, but trying to stay short Apple for me has never worked. Never, not once. Taking some jabs at it, yeah, that works good. So this is the range that I would be focused on, 191 to 188 with the 50% mark at 189.33. If I'm looking for a short, I would want it to, at the very least, get below that 50% mark. But as you can see from the candles that are already there, we can cut down through it and come right back up again. Closing below it is the point, right? If it don't close below it, then it doesn't count. It almost seems like some easy money. If we're going to get small caps moving today, and we see things like growth calling a back seat today, then credit spreads either at the money or a little higher out of the money on things like Microsoft, Apple, Netflix, maybe Google. I'm a little, I don't know what I want to do with Google yet, but it kind of makes sense that we see a little bit of a timeout, a little bit of a pause going into the weekend, some 0-day stuff on these things. The main idea is for like what we had in Microsoft. That's just a perfect example. We gapped up crazy bullish and then just gave it all back. That's a nice way to go on a Friday, just like that. Get that gap up and then a dump down. But we were just talking about it earlier, right? That we continue to see bullish moves, that it continues to hold these highs, that we're just not selling off and falling down. And so, we're not talking about, quote, taking the market short. We're talking about taking the market not higher. 45.54 is the ADR half. To remove all of the fancy language, ADR is average daily range. Over the last 21 days, what have we done day after day after day? We've gone about 1.19% on average. So just about as far as that red line. So what's the expectation today? That we're going to go to the red line, do what we've been doing day after day after day over the last 20 days. Now we had that big explosive move this week. And so over the last 3 days or 2 days, we haven't hit the line, but I run that line every day. I'm looking at that line, trading against it. I'm trading towards it. I'm focused on it. We hit the line there. We hit the line there. We hit the line here and here and here and here and here. You see that here and here and here and there too and here. We hit the line a lot. It's more likely that we hit that line than miss the line, right? That's kind of the takeaway. I don't have the numbers for how often we do and don't hit the line, but I will soon. Until recently, I didn't have the capability of looking back over previous days, and I do now. So we'll have those numbers soon. But statistically speaking, you're more likely to hit the red line than not hit the red line, which is good to know, right? So if we're feeling bullish and we already know that we're statistically more likely to hit it than miss it, then an out of the money call at the open for the red line on SPY or SPX kind of makes sense. And of course, after we get there on a day like this, kind of makes sense to put on a call credit spread saying, I don't think we're going to really go past it on Friday OpEx. That's what I got for you guys. Be careful, be safe, keep your eye on the clock. Have a good weekend. I'll see you on Monday.